properties. Vessi is a founder of Dream, Believe, Achieve Capital Group. Vessi empowers professionals to build wealth through strategic real estate investments, fostering passive income and financial freedom. Vessi, we're excited to have you here today. If you could let the listeners know a little bit more about yourself.
Absolutely. Very excited to be here today, Josh. Appreciate the invite. Happy to be here. Vessi Kapoulian. I'm based in Los Angeles, California, and founder of Dream, Believe, Achieve Capital Group. I've started my real estate journey, like many, with one small investment and the first single family home, which eventually scaled into a larger portfolio, and that led me to transition to the multifamily space. And now I'm helping others secure their financial freedom and achieve optionality and additional income streams.
That's awesome. So tell us, so from single family to multifamily, large multifamily, if you could just tell us the journey, what got you there, and the steps that it took.
Absolutely. So there were a lot of clues along the way that added up over a period of time before the light bulb went on and got me thinking about actually investing in real estate. Namely, I followed more of the traditional path of going to school, getting a job, grad school, and starting to climb that corporate ladder. And quickly realized I was climbing the wrong ladder because as I looked up, I saw more people trading more time for money. Then my own employer went through a couple of restructures, and through one of those, I saw colleagues very dear and near to me being let go, and that had nothing to do with their talent level or how hardworking and bright they were. And then, of course, the macroeconomic events like the global financial crisis that left a lot of people without retirement portfolios and or without jobs. And so that led me to think over an extended period of time, what do I do if that happens to me? Because I'm not insulated. Doesn't matter how hard you work or how smart you are, that could happen to anyone. Or what if we go through another crisis? And in those moments of crisis, I think we fall back to the habits we have. And for me, growing up in Bulgaria, where there wasn't a developed stock market, when people talked about investments, they talked about investing in real estate and hard assets. And so in those moments of crisis, I resorted to what I thought I should do next, and that's buy a home. And I thought of it as my little retirement nest egg, a way to diversify from the stock market and avoid some of those fluctuations. So it really started with buying a single family home. And as a person living in Los Angeles or in California, for me to buy a cash flowing property would have required a pretty substantial down payment. And so naturally that led me to look out of state. It was a very scary process because I was always taught buy something in your backyard, but that was not an option for me. So I started doing a ton of research, going to local meetups, connecting with fellow investors, and through one of those connections, I was able to find that first home in Tennessee, which was a market I had previously visited, so had some familiarity with, but of course did additional research. And that investment did well, helped me overcome that initial fear, and that led to expanding my residential portfolio. And before I knew it, then the light bulb went on and got me thinking, well, this is not just a small retirement nest egg. That could be something bigger, not only for me, but also allow me the opportunity to help others. And that's what led to the transition into multifamily. And I can talk about that, but I'll pause for a moment.
Yeah, so you're in California, and then you invested in a single family house in Tennessee. Is that correct?
Mm-hmm. Correct. Mm-hmm.
So that process, were you working with a realtor, and the realtor would kind of find your resources as far as property management and tenants?
So yes, the contact that I connected with here locally already had that infrastructure set up in specifically in Memphis is where I invested. And so I got connected with an agent. They already had a few properties actually available. So I picked the one that made the most sense to me relative to my investment goals and criteria, and we got to work. Since then, I've worked with that agent multiple to source additional properties in that market.
Got it. And then those properties, were they turnkey or were they needed to be renovated and then brought to market?
They didn't need heavy renovation, but over the years, I've done some updates to them. So I wouldn't necessarily categorize 100% turnkey, but they were, for the most part, tenant ready. The one I purchased was vacant, so we did have to do some work as far as advertising and getting it cleaned up. But it was not a very heavy lift for from that perspective.
Got it. At what time frame did you purchase that property? Was it
So that was back in 2017 is when
okay?
we closed on it. So it's been about 6, 7 years. Yep, 7 years.
And you were before the massive run up on house prices too, so that helped out a ton, I'm sure.
Absolutely, yes. And then throughout my career, I've learned not to time the market. I had other situations where actually, I guess my very first investment was a home, owner occupied home that I bought, but that was the purpose for that home was to effectively fund my graduate school education. So I knew that was going to be a short term hold. I sold it right before during the '07 peak, so right before the market crash. But I wasn't a genius or anything special. It just I followed my investment thesis, investment plan, and when the time came to sell property, I didn't really get caught up in negotiations with the seller. Yes, it would have been nice to maximize the sale price, but the offer I got was fair and consistent with my goals, so I moved on. I vividly remember the thought that ran through my mind at the time: don't be greedy, just follow your plan. And I'm so glad I did, because if I had gotten caught up in lengthy negotiations with the seller, a couple months later the market crashed or started crashing. So I probably would have lost money on the property. So just not trying to time the market, but just following my investment goals and reassessing the situation as events and market conditions change.
Yeah, and there's a whole nother adage: you can actually buy the market down too, which
Mhm.
ultimately, if it's a long-term hold, if that's your strategy, it's
Mhm.
not relevant. But if you're in a flipping world where you're buying at a basis right now with an ARV of X for 6 months from now, that could totally
Mhm.
change your business
Mhm.
plan. So, but the buy and hold, it's you're in a 3 to 5 year exit, so you're safe depending on the cycle. Um, Okay, so we got in single family. You've proved yourself. You're building confidence. You're now you're ready to scale even more. So if you could tell us what mindset changed to scale into bigger multifamily.
Yeah, so when the light bulb went on, as far as hi, this could be something really bigger, not just a small retirement nest egg, I started doing the math, and it became clear that I'll have to purchase a whole lot of single family homes, and that will take a really long time if I was going to do it by myself. And so as I started reading as well as thinking about what would be the next step, multifamily came into the picture. Why multifamily? Because I already had some experience in the residential side, managing my portfolio remotely, managing the manager. My W-2 job was a commercial lender. So as a commercial lender, I had some experience, at least from a lender perspective, underwriting commercial properties, including multifamily. So that was a good way to apply the skill sets that I already had into that transition. Started reading a ton again, connecting with other investors, really investing a lot of time in my education. Joined a mastermind, a paid mastermind, with like-minded, motivated individuals who some of whom later on turned out to be my partners. But really did a deep dive, and the first step I took was education. Once I made that decision that multifamily will be the asset class I'll focus on, and then as I was connecting with people, the one question I had on my mind and the one message I always look to leave with others is, how can I help others? How can I add value to others? And for me, naturally, that resorted to underwriting, ability to vet deals, vet operators, And eventually I added ability to attract capital to my skill set. But initially it was that underwriting skill set that eventually got me into a partnership and my first deal, and then the second, and so forth.
Yeah, I'm definitely passionate about underwriting. It's amazing how you can the numbers tell the story, and
Absolutely.
what looks like a great deal on the surface, you plug the numbers in, you find out, hey, this is definitely not doable with the way things would go right here. So, tell us a little bit about underwriting, how you sharpen your axe and stay and just because if you keep using the skill, the skill just keeps getting better and better, and you can see numbers in a different way. Tell us how that journey went for you, how you learned how to do it.
Absolutely. So the really the most I learned it was from underwriting deals, and that's pulling the information from LoopNet and, for example, or Crexy, finding deals there that were in my target market and analyzing those. Now, I did have some background as a lender and reviewing deals from one perspective, but as an operator and as a lender, typically you look at more of the downside and what is the downside risk and how you mitigate it. As an operator, right, you're purchasing these properties with the intent to make profit over the intended hold period of time. So you are looking at the upside, you are looking at the pro forma. So that was a different aspect or a different part of the equation that I wasn't previously exposed to and had to learn. So through that mastermind that I was part of, there were a lot of educational resources as well as buying looking and reading through additional books and information, joining meetups. But really, the most I learned is through putting in the reps, and it's analyzing deals, going deep in the market, because that having that market knowledge is extremely important when you're underwriting a deal. And not all markets or even sub-markets within the
Yeah.
same market are created equal, and that can vastly impact the numbers. And you cannot take away the factor of rolling up your sleeve and doing the work. So that's how I learned the most.
Yeah, and some areas are truly street by street. One street is thriving great, and the next street over, you really shouldn't buy a property on that road. It
Absolutely.
that gets into your economics, and then of course there's some really good software out there too that can help you make good decisions. But once you actually get out there, like you said, roll your sleeves up, walk the area, walk the property, and just validate everything. That's where it's the rubber meets the road, so to speak. Um,
Yes.
right now, with the way the market is, how are you underwriting future rents and your performa?
Yeah, that's an excellent question. And the one thing I love about writing is that it's not static. It's ever evolving with the changes of the market, property, macroeconomic conditions. So when it comes to the pro forma, definitely being more conservative as far as rent growth assumptions are concerned. Really looking back to understand what is the long-term growth average for that market, and really depending on the property in current market conditions, supply, demand, absorption, maybe even not forecasting rent growth in one, even though, of course, that's not the stated purpose. Similarly, understanding the vacancy and what the long term occupancy trends are for that market, because again, we are in a unique position, and some markets are faring better than others, but it's important to understand if certain markets are going back down to that long-term historical average. And for expenses, depending on one of the markets I follow is Florida. So insurance there has really gone through the roof, and not only has increased, there's a lot of uncertainty with renewals as well. So evaluating not only the insurance risk aspect and the cost and baking that into the pro forma, but also really understanding the property. If you're buying an older property, the risk of drop of coverage is extremely high. And so in some cases, I may not even evaluate older properties because I don't know. I don't want to deal with that uncertainty, especially when you have other parties involved, including the lender. So it's really going down line by line and evaluating if some of those prior assumptions still hold true, and validating those with third parties, whether that's your property manager, insurance broker, lender, boots on the ground contact. It's one thing I've learned is to at least have a couple of sources to validate your assumptions through and not just rely on one.
Yeah, I totally agree. And even having a counterpart just underwrite, and then you guys come together. Even different spreadsheets underwrite differently as well. I
Mm-hmm.
definitely like to stay consistent with the sheet, but then
Mm-hmm.
re-underwrite the property after we're going through the renovation and the lease up, and just see where the numbers are versus true actual numbers versus pro forma. Um,
Yes.
on the rent growth, and that is definitely hyper local on rent growth on we're at in the market, and as far as what portion of the United States, the Sun Belt is. There's a lot of hype, a lot of growth, and I think that it's going to definitely normal, not decrease. We're over in Cincinnati area, so we're seeing rent growth, but I think it's catching up to the everywhere else because Cincinnati is typically slower to respond on a lot of different things, whether it's just population growth or job growth, just really steady Midwest market. But we'll see. On our end, we're underwriting between 1.5% to 2% of rent growth over the next 3 to 5 years, and it's not your 3%, but I feel like maybe we're at a plateau level where we might see a drop, and if it goes higher, great. If not, then we're still conservative.
Mm-hmm.
Where are you seeing interest rates at in 2024?
Yeah, so I think we've probably reached the peak, at least based on some of the macroeconomic data points that are coming through, coupled with the Fed's messaging. So the question is lower rates next year. I do think, if you ask me officially, we're in a recession. That's typically when they start lowering rates, but lagging economic indicators are not showing that just yet. So we are probably going to experience a mild recession in sometime in 2020, at which point they will start lowering rates. Um, we also have elections coming up. I don't know if that will be taken into consideration into their decision making, but that may be another factor. And I say lower rates personally, I'm not a big drop. We're at what 5.5 as far as Fed funds and 8.5 right prime rate. I maybe 25, 50 basis points. I don't anticipate a big drop unless something really drastic and really, really bad happens, not only locally here in the US, but also globally. And that could happen. But at least based on the short-term horizon, as of today, it's difficult to envision that. So as I evaluate deals, I plan on the rate staying higher, that 5 to 6% range, higher for an extended period of time, and then at least over the next 3-year horizon. And who knows what will happen there, but I would rather
Yeah.
plan for the downside and be happy if the upside happens.
Yeah, I think we heard a big run up, like the Fed can't raise rates, can't raise rates. Here's why, and then they start raising rates, and now I'm hearing survive until 27. It was survive until 25,
Mm-hmm.
and then UBS sent out a pretty massive report for their what their data is predicting for next year, and they're claiming like a 275 basis point decline by the end of the next year, which
Wow.
would be incredible. So there's so much mixed messages out there that are it's all conflicting and contradicting each other. But I agree, 50 to 75 basis points. It's election year. That's been historically on point. Just kind of show that a boost in the economy right before the votes come in. But who knows? I mean, it could. We lived through 2020, so we could see even more interesting things. It's hard to tell.
Yes. Yes.
Um, so tell us what, as far as like investor wise, what they can expect if they were to go the active route or the passive route, and which one the experience that you now have, which one you would prefer.
Mm-hmm. Yeah, I have experience on both sides, so I still like to be very engaged, and this is my full-time occupation now. So for that reason, I've chosen the path of active investing, and effectively, what that means is being in charge of the upfront diligence, deep diligence on the operator or partners. You will be collaborating with markets, as well as doing the underwriting and evaluating the deal. And then throughout the intended hold period of the investment is managed out on a daily basis, having weekly calls with your property manager or regional manager, addressing situations as they arise. Basically, roll up your sleeves and doing the work. The beauty of real estate is that there are many different ways one can get engaged with and participate, and so passive investing is another option for people to get engaged if they don't have the time or desire to deal with daily operations, be in charge of making those decisions, doing the heavy vetting and diligence upfront, making disposition decisions as well. So passive investing allows for people to do that, and in exchange, they don't, as limited partners, passive investors are also shielded from liability, but it doesn't mean they have no right or partners in the deal, and there are mechanics and stipulations that are in their favor as well, to the extent the management team is not performing and so forth. I do invest passively as well, and that's how I diversify my own portfolio. As I love multifamily, but I also don't want to be 100% in it. And so looking at other commercial asset classes is how I've chosen to participate down the passive route.
Yeah, that's I like what you say. Just be diversified, but know your information, know what you're getting into, be educated. I think that's first and foremost. Know that real estate's very it requires patient capital. Because it just takes time. The way the properties are positioned now and where they should be on performance, it could take 1, 2, 3, 4 years to get there. And ultimately, if the business plan works out and you've got a great operator, you've got everything that comes together, and it works out. What do you look for in operators if you're going to invest side by side with another partner?
There are a number of criteria that I look at. First and foremost is building a relationship over a period of time, getting to know them to ensure our values, personal values, are aligned, and that takes time. To your point, from a resume standpoint of view, I'd like to see that they've had a successful track record that's managing properties, how they've performed relative to their original projections and the budget, how they have fared in terms of exits or how many exits they've had. Ideally, I would like to see operators that are vertically integrated, because that allows them to be one step closer to having control of operations. But I understand that's not how everyone chooses to participate. So to the extent there is a third-party property manager involved, I'd like to see that that particular operator has had an extended relationship with them, working over a period of time, working through multiple properties and performed. And then beyond that, I look for consistent communication, ideally monthly financial updates, transparency in communication, frequency, and to what extent the operators are or the other sponsors are also participating in the deal. I co-invest with my investors, and I would like to see the same with my GP partners. And again, that could be monetary, or that could be in other ways, such as signing on the loan and such.
Yeah, that's the ultimate. That's the clubhouse, especially if you're in Fannie or Freddie. It's the and you're using your balance sheet to make the deal happen, and it's well deserved.
Absolutely.
The being vertically integrated as an operator, I think, is the ultimate success vertical, because you're not relying on third party to communicate effectively, to execute on your business plan, to push the property, push the expenses, and shrink those. We were relying on property management, and once we became the property management company plus the renovation plus the operator, I mean, we've got full global control over all aspects, and we just performance went through the roof. You're getting in the weeds on a lot of things you shouldn't be, and you don't want to, because ultimately your ability to grow faster is it's just not there. You can't be, but you're growing more at a wholesome rate, and you're able to control things. So it's there are the pluses and negatives, but we've seen some great turnout. And if it's the right property, big enough in a different market, you develop that relationship with third-party property management. Your values are aligned, like you just mentioned. Then it can work too. Then it's an extension of management, and you work harmoniously together to make sure it works out. For sure. What has been one of the biggest learning lessons that you've had so far in your career?
Well, that's a great question. I would say is as far as seminar is do your diligence and don't be afraid to walk away if the numbers don't make sense. Fortunately for me, I got that lesson earlier on while I was in the single family space looking at a small multi, and the owner made a ton of excuses as to why I would see one particular unit. Eventually we had to walk it because that was part of our diligence process, and we found out that it required a much more substantial rehab than what we had budgeted for, and what where the purchase price made sense at. So that was a good lesson learned, is walk all the units early on in the process that we can now apply to the multifamily space. There have been many other seminars I mentioned earlier, like for example, validating your assumptions through a couple courses, not just relying on the property manager or maybe your boots on the ground, but run it by a lender, maybe through another contractor if you're looking at rehab. So I can talk a lot. Various lessons, those would be just a couple. Really boils down to do your diligence, trust but verify, and really double vet the data and the numbers.
Yeah, and there's a high level of excitement once you feel like you've got a deal and you want everything to go, but it's getting over the excitement and just digging in and making sure that everything is what it should be. Because you can factor in the cost if it's not. It's not that the deal won't close, but now you have to take into account certain things that now need to get done. And ultimately, if it's information that was held from you before, say, an LOI or PSA, now you've got to kind of go back, circle the wagons, and say, hey, look, this is a surprise to us. Wasn't a surprise to you all, but now let's join forces and get this thing closed. So things happen, but communication's key, and can work out. What getting back to the market for next year, what are you seeing out there on the lenders' optics as far as loans and liquidity and all that good stuff?
Yeah, from a lender perspective, and we've all started seeing that as far as I don't want to say tighter guidelines, but to some extent the loan proceeds are really predicated on the cash flow of the property, and because cash flow has been constrained, lenders are now reduced to value or how much they're putting in a deal. Beyond that, in terms of the larger banking landscape, we went through the 08-09 crisis and the Dodd-Frank that introduced a lot of regulation, at least for the larger financial institutions. Now with the fallout of SVB and other financial institutions, I think what that will result in is more regulatory oversight into the so-called mid-tier banks. And what that will do is introduce additional compliance requirements, which in effect will also increase their cost of operations. For other mid-tier lenders, that will also lead to reassessing their internal concentration caps. Each lender has concentration caps by industry, so real estate being one of them. All in all to say that there may not be as much capital available to lend, either due to higher costs or due to higher internal caps or more regulations. And so the ability to raise capital privately from your investor pool or other connections will be key in making deals happen. There will be a ton of deals. A lot of maturities are coming due, and some operators will be able to negotiate extensions. We're not going to see a huge fallout for some deals, particularly for operators with a good track record, strong balance sheets, access to liquidity, and built-in equity, but for others that are more stretched, those properties will have a credit event, and the operator will either have to sell or refinance if they're able to bring more equity to the table. And so I think that will present great buying opportunities, at least over the next 12 to 18 months. But access to capital would be key, and lender will continue to be one part of the equation, but private capital will fill in a pretty sizable gap as well.
Yeah, for sure. I totally 100% agree. It's lenders are being more, I think, selective on what assets they have, real estate assets they have on their balance sheet too. And cash flow is truly everything. They don't. No one wants to have a bad balance sheet, especially the banks. And if they're going to deploy capital, it's going to be at the right asset, right age, right vintage, all that good stuff. Have you heard anything as far? Go ahead. I'm sorry.
I was going to say cash flow and the relationships you have, and the track record of the operator. Those would be as well.
Yeah. Yeah, for sure. Real estate. I mean, you're a business owner ultimately, and how well you can pivot and make moves, sense of urgency, is all things operator. You have to be able to have a track record and just make sure the business succeeds. Make changes as changes are needed. Have you heard anything as far as real estate tokenization on the blockchain?
Haven't really dove into that subject as much. I hear a lot of chatter about it, but haven't really followed that topic as closely.
I was listening to some market news this morning, and it came up again. Like BlackRock, Blackstone, they're all with ETFs for real estate, like just getting different regulatory things through the SEC. So it's interesting to see what comes of it. I've been following it. Went down a rabbit hole deep a couple of years ago, but it's just like anything else, it moves very slow. So if you get in too early with anything, then it's just too early. So if anything, it could be a thing of the future, but we'll see. Very cool. So Vesse, if somebody wants to learn more about you, get a hold of you and learn more about your company, how they can possibly invest, how can they reach out?
The easiest way to connect with me is through my site, dbacapitalgroup.com. D as in dream, B as in believe, A as in achieve. My contact information is there. There are a ton of resources, including my complimentary digital book, The Busy Professionals Quick to Investing in Multifamily, designed to empower and educate investors.
Very cool. I definitely look forward to following you and appreciate your time today. We'll certainly talk soon.
Absolutely. It was a pleasure, Josh. Thanks again for having me on.
Thank you. Bye.